Hey everyone, and welcome back to the channel where we cut through the noise with cold, hard data. Today, we're tackling the big one. Should you rent or buy a home in 2025? It feels like we're in a national housing identity crisis. Mortgage rates are camping out around 6.5%. The median US home price is stubbornly parked at $420,000, and rents just keep marching upwards at 3 to 5% a year. It's a tough call. Do you lock yourself into a 30-year mortgage, or do you stay nimble with a lease? In this video, we're going to run the numbers. No hype, no get-rich-quick schemes, just publicly available data so you can make a decision with real confidence. Let's start by setting up a baseline scenario using national averages. Imagine you're buying a home for $420,000. You put down 10%, which is $42,000. This leaves you with a loan amount of $378,000 at a 6.5% fixed rate over 30 years. Your monthly principal and interest payment comes to $2,391. But wait, there's more. Add in property taxes, which on average are about 1.04% or $365 a month. Then tack on home insurance at about $142 a month. And finally, let's not forget maintenance. A good rule of thumb is 1% of the home's value per year, which breaks down to $350 a month. Add it all up, and your total cash outlay in month one as a homeowner is a hefty $3,248. Now, what about the renter? The median rent in 2025 is projected to be around $2,175. Add $15 for renter's insurance, and you're at $2,190 per month. For our model, we'll assume rent grows at 4% per year, which is right in line with the 10-year post-COVID average of 4.2%. Here's the crucial part. What do you do with the money you not spending on a house? The difference in monthly costs is $1,058. A savvy renter would invest that, along with the initial $42,000 they didn't use for a down payment. Assuming a 7% annualized return after inflation, that's a powerful wealth-building engine. So let's fast forward 5 years and see where each path leads. We'll compare the costs and the net worth of our owner versus our renter investment for the homeowner after 5 years. They've paid down about $36,900 of their mortgage principal. That's equity. Let's also assume the home appreciates at a conservative 3% per year. That $4,120,000 home is now worth around $486,000. So, the homeowner's total equity is their $42,000 down payment, plus the $36,900 in principal paid, plus a $60,000 gain from appreciation. That's a total of $142,900 in home equity. But what if they need to sell? Selling isn't free. Let's budget 6% for agent commissions and 2% for closing costs. On a $4-100-80-$6,000 home, that's roughly $38,900. So, the net liquid equity after costs is about $104,000. Now, what about the total cash spent over those 5 years? The principal and interest payments add up to $143,460. Taxes, insurance, and maintenance come to another $51,420. That's a total cash outflow of $194,880, a huge sum. Let's switch over to our renter investor. How did their portfolio do? That initial $42,000 plus $1,058 a month, growing at 7%. After 5 years, that portfolio is worth a whopping $132,300. And what about their total rent paid? Factoring in that 4% annual increase, their total rent outflow over 5 years is about $141,400. All right, it's the moment of truth. Let's compare the net worth delta after 5 years. The homeowner has a net position of $104,000 in home equity. The renter investor has a net position of $132,300 in their investment portfolio. In this specific average scenario, renting wins by about $28,000. Why? It's simple. In the early years of a mortgage, your payments are overwhelmingly interest. Combine that with taxes, insurance, and maintenance, all costs that don't build equity, and you have a massive financial drag. The renter, meanwhile, is maximizing the power of compound interest on their saved cash. For this specific rate and price combination, the financial break-even point, where buying pulls ahead, doesn't happen until around year 9. Of course, these numbers aren't set in stone. Let's run a few sensitivity checks to see how things can change. What if mortgage rates drop to 5%? That lowers the monthly payment to $2,028, and suddenly, the break-even point moves up to year 6. What if you live in a hot rental market like Miami or Phoenix, where rent growth is closer to 6%? In that case, the renter's advantage disappears by year 7. What about taxes? If you re in a 32% marginal tax bracket and can itemize your deductions for mortgage interest and property taxes, that could save you about $3,200 a year. This narrows the gap in year 5 to only about $20,000. And finally, history shows that if you plan to hold for 12 years or more, owning wins out in about 70% of US metro areas. Time is a homeowner's best friend, but life isn't just a spreadsheet, right? There are huge non-math factors to consider. Flexibility is a big one. Renters can move for a new job or a change of scenery with minimal cost. Owners face about 8% friction in selling costs. Then there's leverage risk. Putting 10% down means you're 5 times leveraged. That's fantastic when the market goes up, but it can be absolutely brutal in a 20% downturn. On the flip side, a mortgage acts as a form of forced savings. Each month, you're automatically building equity, which is great for people who aren't disciplined savers. And you can't put a price tag on the psychological utility of owning a home, the stability, the freedom to customize picking your school zone, having pets without asking permission. For many, that's priceless. So, what should you do in 2025? Here's a simple action framework. If you know you'll be in a location for 3 years or less, just rent. Don't even think about buying. If you have a down payment of 20% or more, plus a healthy emergency fund, you can start considering a purchase. If you can find a mortgage rate at or below 5.5% and the price-to-rent ratio in your area is under 17, that leans towards buying. But if you re-in a high-cost metro where home prices are stagnant and over 10 times the median income, you're likely better off renting and aggressively investing the difference. Let's do a quick-fire Q&A on a few common questions. What about private mortgage insurance, or PMI? If you put down less than 20%, this adds about 0.5% to your effective rate, pushing the renter's break-even point even further out. What about VA or FHA loans? A VA loan's zero-down option is great for upfront cash, but comes with higher funding fees. You'll need to rerun the numbers for your specific situation. And what about house hacking by renting out rooms? That can completely flip the financial calculus from day one. But it's not a direct comparison to just buying a primary residence for yourself. Look, math isn't everything, but it never lies. At a 6.5% mortgage rate with home appreciation under 3%, the numbers suggest that renting and investing the difference beats buying until about year 9. But if rates slide, prices dip, or you're truly planting roots for the long term, buying eventually regains its crown. The key is to know your own numbers and your own timeline. To help you with that, I've created a free document linked in the description below. You can punch in the numbers for your own zip code and get a clear answer in under 10 minutes. If this breakdown saved you from $100,000 of potential regret, do me a favor and smash that like button. And be sure to subscribe for more nonsense all facts money analysis. Thanks for watching, and I'll see you in the next video.